Well, are the tides of change upon us once again, or could we be seeing more in store in terms of this financial tightening we've been seeing? Bond markets have obviously been selling off and yields have been ripping higher. Is there more in store there? As we see a rampaging US dollar as exceptionalism continues to plague FX markets. Did the Japanese intervene or did they not? And we ask what's the next stage for the Japanese yen. As we also preview the non-farm payrolls number and look ahead at the marquee event risk for next week, which of course is the US CPI print. This is the trade-off. Well, hi there, my name's Chris Weston. I'm head of research here at Pepperstone, and we're joined in 2 seconds by Blake Morrow from Forex Analytics. And we are going to be going through all the factors that are plaguing the markets, the setups that we like, and everything that we need to look at to assess risk and make informed decisions. Mr. Blake Morrow, coming to the programme, my good man. How are you?
I'm doing great. Welcome back, Westy. We missed you.
Oh, mate, I saw a couple of shows that you and Mikey Brown did. Kudos to the lad. He was up at midnight to do the shows, plenty of coffee. Did a fantastic job. I know the audience really warmed to the pair of you, and some great information there. So well done. And obviously,
thank you.
You go away for a little bit of time. I think at the moment I stepped out of the office, we saw sleepy market conditions transcend into slightly higher volatility markets, which is great. We like a bit of movement as we talk about Blake, but hopefully it can continue for a short period of time. What do you think?
Let's hope so. I don't want you to be that indicator that I have been for many decades now.
The volatility indicator.
The volatility indicator. Let's hope you're not that, and let's hope it does persist. So yeah, we've had some nice volatility, some nice trading times, but I think this is great time for you to be back in the hot seat to help give some guidance to your Pepperstone traders. Well,
if we start seeing low volatility kick back into markets, I'm sure Mikey Brown doesn't want to be having to wake up at midnight every time just to reinvigorate the volatility in the markets, does he really? So we have to.
Well, we'll go get you a GoFundMe page, Chris. How about that?
Well, that's right. It's either that or a massive pay rise. So I know which one I would prefer. Anyway, let's go to Topical Thunder and see what's making news. I'm going to start with sentiment, Blake. Obviously, been away. We've seen the VIX trade up into 20%, sort of indicating implied daily moves in the S&P of about 1.3% or so. Obviously, we've seen massive bear steepening playing through in fixed income curves. Nominal treasury yields have been moving up sharply. The dollar's just been on a one way trend. Gold prices have been under pressure. But I'm also in equity markets as well. We've seen about 8-9% drawdown in the S&P futures. We come down into the 200-day moving average, October trend channel support, finding a few buyers there. But, I'd looked at positioning, big pickup in short positions recently in the market. You can have a look at things like the CNN Fear and Greed Index, which had gone down to extreme fear levels. The question then is has sentiment become just a little bit too bearish in bond markets, in equity markets and risk assets more broadly? And is this the time for the contrarian in us to start wading in on the other side of that trade now, Blake?
This is a really, really good question, Chris. And I do follow a sentiment indicator personally called the DSI that actually is nowhere near extreme at this point, Chris. And so that's one of those things that I'm like, is it so extreme? I was also talking to another analyst, and she had worked for Jim Cramer for many years, and she hasn't seen like this capitulated volume yet in the markets. I mean, yeah, volumes are high, but they're not like super high. I agree with you. There's so much support here. I think I tweeted about it last week being a 5-tuplet type of support between 200-day moving average, 161% extension, horizontal support, channel support. There's a few other things, divergent relative strength. All those things do suggest that we could, and kind of what you're talking about is sentiment. We could bounce, but I don't know if we're out of the woods yet. I mean, we're going to be moving topics here in a second that may also suggest.
Well, exactly. I just want to jump in. Sorry, mate. It's been positive that we've seen. Well, oil prices have dropped 12% in the last few days. I mean, that's obviously not bad, not great if you're long energy, obviously, or Canadian dollars or NOK, but from a holistic perspective, it's good. And then we've seen bond yields looking like they're peaking to an extent. I don't think we're out of the woods, but that's obviously been a reprieve for equity markets. So there has been some positive factors playing through. We've got earnings next week, which obviously need to come in. Generally, the bar's always going to be pretty low on that. We generally always beat on that situation. But what happens, and we'll talk about it in the NFP and CPI, but what happens if we get a really hot NFP number, high, lower unemployment rate, good participation rate? What happens if it's well above 200,000? And what happens next week if we get a big CPI number that reinforces a November hike? We're back in play. Equity drawdown. Of course, we could go the other side of that and we could see a weak non-farm payroll number. We could see a lower CPI number and we could be ripped. So we're on a precipice now. We're very much data dependent, and it could go either way, right?
We can, and I think when we get to the NFP topic, I think you have to prepare for both situations, especially with jobs report and then, as you pointed out, inflation data. I don't know if hot is good or bad, but I think you have to prepare for either situation at this point. So anyway, but we're going to get to that topic, so make sure you don't go anywhere. Let's fast forward to the next topic. Let's talk about the bond market, because bonds have been, people say, oh, here comes the dollar wrecking ball, but the bond market, the 30-year touched 5% today. Now, we've seen a bit of a reversal, and I have to point out, it isn't just a U.S. story. If you look at Boons hit support. Gilts, they haven't hit new cycle or trend lows, but they're down there. So it's definitely a global issue, but yields have been on the rise. The bond market has been, just getting destroyed. Everybody looks at the bond market, says, is it a value proposition down here? Is this a good place? I have opportunities to put money in safe haven type of vehicles and get a decent annual return if I've capitalized on the markets this year. What are your thoughts on the bond market, especially with, yields, real yields, let's just say real yields? Do we still have further to go here, Chris? What are your thoughts?
I think the upside's fairly limited in terms of yield now. But I also I can't really make a huge impact for downside either, to be honest. You make a great point on the real rates side of things, because 10-year real rates have gone from around 135 in this run, mid-year to where we got to a high yesterday of 2.46%. That is a massive tightening of financial conditions. There's higher for longer stance from the Fed is keeping real rates high. That's where we're going to get the tightening of financial conditions. That's where we're going to get the slowing of demand as real rates stay high for a period of time. People have been trading the steepener. The 10-year Treasury has been moving up. The yield has been moving up more aggressively. So it's a bear steepener. What we actually typically see as we go into recessions is a bull steepener. That's where you see the 2-year Treasury yield actually find buyers and yields falling as rate cuts come out, and that's not happening at the moment. So we're seeing a bear steepener. That's been one of the sort of trades du jour from the insto crowd, and that's been a massive move that's been taking place there as well. But I find it hard to see. The 10-year may get up to 5% maybe, but I think we've had such a material shift in the bond market over the last month or so that it feels that we need to have consolidation after this run. Obviously, that really depends on what happens with payrolls. It depends on CPI numbers next week. I'm not going to call this. I'm not going to call the bull market run or the bear run that we've been seeing in bonds. But there's no doubt in my mind that this is what everyone's talking about, right? Are you buying? Are you buying these bonds now?
No, I'm not, and I'd actually be a seller on any type of rally. I think that's the point I want to make, is that I think the trend is entrenched. Yields are moving higher, and the mantra "higher for longer" globally is probably going to be a sticky one, and it's going to be something that's going to keep rates very well bid. And as long as the economic data doesn't just completely hit the fan, over the course of the next couple of weeks, I think we have to continue to look for lower bond market and higher yields. So
I want to just throw something out there, just Blake. What happens when we get into the latter stages of Q4, crystal ball time? We've got demand will slow down, in my opinion. We will see slower growth. The Fed are forecasting that. I think that's the path we've got to look at. But what happens with the shutdown? We've got student loans which are just starting to kick back in. Their repayments are kicking in. We've got auto strikes which are increasing, and we're going to have another shutdown that comes through mid-November. Now the shutdown, it's not a market story, but now we've seen the speaker McCarthy being removed. The new speaker is going to find it Speaker McCarthy, I'm sorry, producer, I'm sort of going on a rant here, but he managed to get shit done, right? He could actually, get deals done. We saw that with the debt ceiling, we saw with the shutdown, and he lost his job as a result of that. Now, what happens with in mid-November? We're going to see another shutdown where each week that it goes on will probably shave about 20 basis points off GDP. So if you combine that, and it should shut down in November. It's going into the end of the year, and it may last a long time because we're going to have a new speaker. He may not be able to get it done, or may have to really enforce that fiscal discipline. So I think that we're going to see a situation in Q4 where we could see that seasonal situation where risk assets rally. That growth could come into question there.
Yeah, no, I couldn't agree with you more. Whoever is the new Speaker of the House, not the temporary or stand-in, I forget what the right term that they're using right now. Whenever we have a sworn-in Speaker of the House, they're going to have a very difficult time keeping this government open. And in 45 days, where the clock's ticking, we're 43 days, 42 days, whatever it is, we are going to probably end up shutting down. But I thought we were going to shut down this time around. And
well, I would say Goldman's put 90%. The fiscal the recklessness that's happening in Congress, is a big story. I mean, the bond market's telling you about the deficit that's placed. The fiscal deficits have been supporting growth, but it's a big problem, and so that's something that will. I mean, obviously, the other big part of this is the aid to Ukraine, and that looks like it's going to be problematic going forward. So I suspect that they get, the aid to Ukraine from the American taxpayer, I think is probably going to struggle going forward as well. Anyway, I want Blake keep your lips to. Moving on.
Well, this is your topic.
So is it right? Sorry, I've been out the game for too long. Look, Bank of Japan. Obviously, we got the JOLTS report day or two ago. It was good. There was a hot number. We saw dollar yen trade above 150, and then it wouldn't take long. We saw massive volumes going through yen futures. Interbank volumes were sky high, and we saw dollar yen collapse into the 147 load. Was it intervention? Was it not? I get a chance to go first here, Blake. It wasn't intervention, in my opinion. It was too orderly. Yeah, it was a rapid, near 300 pip move to the downside. But I think what you saw was ultimately, dealers ringing round. The Ministry of Finance doing the ring round. We're checking levels. We're calling up. Getting on the blower. Calling up the liquidity banks, the investment banks, saying, what's your rate now? And that was enough. The bids pulled out of the market. It was a liquidity cascade that came through. Bids came out of the market. The algo sensed the lack of bids. Bang, down it goes. Liquidity, that just pulled it down. And then it came back up to 149 fairly quickly. So it was too orderly. If you look at the vols market, no one was buying volatility. In fact, implied volatility has actually come down a little bit since that point. So I thought we just did the ring round. It wasn't proper intervention. But what it does tell me, for me, Blake, now, if we get above 150 again, that's your level. That's your danger zone. I want to do that. The Tom Cruise song. But no, I think that's what it is. I think they've told you. And the fact that they've been purposely coy about the situation says they want the market to believe that they're very close to intervening, which would cause a 500 pip rip to the downside. So maybe a hot CPI number, hot non-farm payrolls gets above 150. Maybe they do intervene then, but we are on notice. But I don't think they intervened. What do you think?
No, I do not either. And I think it was Reuters that reported it this morning. They didn't believe it. My colleagues, we discussed it early this morning with our community, and we don't think it was intervention either. However, I've read some analysis post rate checking, and usually intervention itself happens afterwards. So I think you're spot on looking for, if you look for a higher rate, you look for the market to push up towards 150. There's so many yen bulls that want out. That means you want a lower rate. I can only imagine what the retail platforms where they're at as far as yen longs go, a lot lower too. That means if the dollar yen's closer to 140. So there's not enough people out. We think the market's got to squeeze a little bit of them out a little bit more. But I do believe we will have intervention. And when it does happen, Chris, if it does happen, you're right on a hot number. maybe even a hot CPI number going into next week, we push up into 150. That would be the level that I think is you're going to start to see action. But it is interesting. I think it was an algorithm, bids pulled. It's interesting. We had a lot of traders with bids down there that ended up getting filled. So
there's a lot of buying the dip crowd out there. I mean, we're seeing a mixture of carry traders who probably aren't thinking about doing carry anymore on that pair and yen crosses more broadly. And we've seen a few sort of special situation, event-driven sort of trading who have been hoping for this intervention and saying, the upside on yen on dollar yen is probably capped. And the intervention, and they've been hoping for this sort of moment, so they would have been sitting pretty. Hopefully, they got out of that trade. What I will say, though, is we don't get the next Ministry of Finance data till the 31st of October, so we'll see whether they did actually categorically intervene on that date. So that will give us the intervention when we look at their FX reserves and bits and pieces. So that will give us the category, but I don't think they did. Anyway, moving on. One to think about, though. Definitely one to think about. It's a tactical situation, especially if we get a hot non-farm payroll numbers. Blake, tee it up.
All right. Well, hot. Here we go. Let's talk about the jobs data. But, also the great thing about the yen, it is bringing a lot of two-way action. So, but with the jobs report, two-way action, that's what it's all about this month. It's going to be, we have the jobs report coming up on Friday. Thankfully, our government's still open here in the U.S., so we are going to actually get the jobs report. I was preparing to actually trade aggressively on the ADP data this week, although the ADP data did clue us in that, it came in a little weaker than expected. 89,000. Yeah, a little weak. Well, a lot weaker than the market thinks. I do believe we are getting to a point where we might start to see some weakening of economic data. But then again, everybody's been forecasting that for quite some time. So, and the U.S. economy has been much more stubbornly stronger than people have anticipated. Very resilient, very resilient. Now, this month, you gotta think about how you want to play it, because I do believe that the market got from the Fed higher for longer because the data is strong. I believe that the market actually that message resonated with the market this FOMC. Therefore, if the data is stronger and even in line, let's just call it in line, I think the markets might flinch a little bit. They could flinch a little bit. We might see S&Ps come back down towards the 200-day moving average, but more importantly, the dollar will firm up. Now, how you play the dollar in a strong dollar or in a strong data environment, I think you have to be shorting the commodity currencies. Look at the dollar Canadian. Talk about teed up. That thing's teed up right up into resistance. Aussie dollar teed up right into support. I mean, it's, you put a little bit of dollar upside pressure and it's going to hit those growth commodity type of currencies across the board. Flip side is if we get some weaker data, I think the euro could be a play. I think the sterling, after this mega fall and finally completion of the weekly head and shoulder pattern, I know we've talked about it here on the show. I can almost 99% sure that we have over the last several weeks. That has finally completed. So I think the dollar could be shorted against many things, actually. But I think if you're going to play the dollar long, you got to play it carefully how you're going to play it long. Yeah. What are your thoughts and how you want to play the NFP? And I'm sorry I took up so much time.
Yeah, sorry, good night. I think that it's difficult. There's so many facets to watch in payrolls, isn't there? I mean, you got the headline level of jobs, which is expected to be at 170,000, which is just a little bit above the 3-month moving average of about 150. That there is a cooling in the level of job creation, which is positive for risk. The unemployment rate is expected to tick down a touch to 3.7%. But again, the participation rate last month was higher, and I think that's something we've got to watch out for. The other thing is probably doesn't get as much attention as it probably should is the revisions. There has been a trend over the last 3 months in the revisions that come down, and I think that's taken the moving average down as well. And of course we watch the average hourly earnings. So all these facets, the market can pick and choose which one it wants to look at any given day. Is it going to be the unemployment rate? Is it going to be the average hourly earnings? Is it going to be the actual level of jobs? And so I think, probably simplistically, I'd be looking at the level of jobs there. But I think the good thing, we saw last night was that we did see a weaker ADP number, but we also saw a solid ISM services number. And that's what we want. We want the growth components to hold up, but we want the labour market just to cool down a little bit. And that's what the Fed want to see, just to mean that we're not going to see more rate hikes this year. So I think we want our cake and we want to eat it. We want the moon on a stick, effectively, and we want lower average early earnings for risk to rally. We want a good unemployment rate, and we want the level of jobs to be around between 150 and 170. That would be your perfect situation for anyone who's long equities in that situation. Of course, next week, though, we go into the CPI number, and the big pain trade for me is the CPI. Yeah, the market has got this strong belief, Blake, that inflation is going to come down towards target next year by the end of, sort of going into Q3 of next year. Anything that challenges that position is a pain trade. And that's therefore, if we were to get a CPI number above 4.3% on core, getting into the sort of the highest threes on headline, that would be very problematic for markets. That would accelerate the dollar buying. I'm not saying that's going to happen, but that is where the pain trade takes place. Quick question. I know there was a viewer question on OIS, overnight index swap, something probably Michael was talking about last week. I'm going to put a link down below in the comments for a new page that we set up on Pepperstone on the website, which gives you daily moves that are taking place, market pricing. It's very hard to get unless you've got a Bloomberg terminal. Probably get it on Reuters and some of these institutional platforms. We're actually replicating that and then putting it on a daily basis to show you market pricing for each central bank meeting. That's actually not our pricing, it's market pricing, the step up and the implied probability of a rate hike. So we'll put that into the link below so you can actually see that on a daily basis. It's actually updated 10 o'clock in the morning each day. So that might be awesome. Of use to you guys if you are looking for that real, well, not that daily snapshot of what the market's thinking there. Anyway, hope that helps. Let's go to That's a Setup. First one I look at, can't go past euro dollar, can we, Blake? If we can bring up the chart on that one. Yeah, we've seen that beautiful trend that's been coming lower from around 112. Yeah, the lower highs and lower lows just been taking place. We sort of traded below that March low. We're finding a few sellers into that level now. Is this going to be a failed breakdown? We don't know yet, obviously. But the trend is very pure. I mean, it's just a straight down situation. I mean, I can bang on about the fundamentals, about the US being the exceptional story. You have seen yield differentials blowing out. If you look at the bottom pane, we can see the German 10-year Bund and the yield discount that we have relative to US 10-year treasuries. And you can see that's the yield on the US treasury is effectively increasing. And again, that's just another factor that's boosting what's happening in the US dollar, because term premiums in the US, what you're getting compensated for holding those longer bonds effectively, has been increasing, and that's pushed the long end up. But you've seen so much working for the dollar. I still think this trend develops, Blake. I still think that selling rallies is the right trade for me in euro dollar at the moment. We saw the retail sales number in the US poor last night, 1.2% decline. There's just so much that's not worth liking in Europe at the moment. But is it too much, and are we going to get a rebound? The technicals at the moment continue to say sell rallies for me. What are you thinking?
I think they do. However, whenever I trade, Chris, I like to have like a line in the sand. We call it a bull bear line in the sand. Above this level, you have to get bullish, or you don't want to be bearish anymore. And below that level, you stay bearish, and you want to just continue to short in this instance. Now, the risk is that, let's say, economic data here in the U.S., especially the jobs report, comes in a little weaker than expected. I think the euro is going to be one of those prime examples of currencies that you can trade on the long side. Breaks back above 106, and then you got a false breakdown, brewing, and then that puts a threat to the upside in the euro. But you also have to imagine risk is rallying at that point. So you want risk rallying. That means stocks going up. You want the dollar weakening. You want yields coming down. You want the euro back above 106. But as long as we stay below 106, I think it's bearish. Now, there's something you don't have on your chart, but I was going to pull up this chart today anyway, so I'm glad you brought it up. But the relative strength as we hit new lows in a new trend low, RSI didn't. So that does suggest that we are going to get this consolidation, or at least some sort of consolidation before a resumption of trend, or maybe maybe even a reversal. So anyway, that's
question for you, Blake. Question for you, Blake. I was just talking to a guy who's working in a bank, and I asked him, who do you think is going to cut interest rates first? Is it going to be the ECB or is it going to be the Federal Reserve? And he was adamant that it's going to be the Federal Reserve. Now, market pricing is definitely skewed towards the ECB, but it's pretty close. They're very, very close in terms of market pricing for when they get it. I'll ask the audience out there, who do you think is going to cut rates first, the ECB or the Federal Reserve? He said the Fed. Market believes it's going to be pretty close. What do you think? Quick question.
I think it'd be the Eurozone, but that would be my take off that would be my gut instinct. But you, the viewer, should jump in the comments down below and let us know who you think's going to cut first. That's an interesting one, Chris. I like it. Well, you know what else you might like? You might like the dollar MEX. You know, we often we name our currency pairs in the Forex analytics community. The dollar MEX is also known as Salma Hayek, just because she happens to be the most beautiful Latino actress of the last several decades, in my view.
And she's 50 as well. It's insane to have.
And she still is drop dead gorgeous. So yeah. We call her Salma. She's been dancing quite a bit, but is Salma, or the dollar MEX, ready to take a little bit of a siesta here and take a little bit of a nap? You know, we just hit the golden fib level, the 618 retracement. We were anticipating us reaching there this week. We got there 1823. We got to like 1821.7 something or rather. But we are trading well above the 200-day moving average. I think the US dollar Mexican peso is going to be a great setup if we do have weakening data, and that means stocks rally just because the NFP maybe comes in short, below expectations. The dollar Mexican peso is going to benefit from, or the Mexican peso should benefit. Dollar Mex had lower. Flip side is, if the data comes in strong, as we've seen it strong for weeks and weeks and weeks, the US dollar exceptionalism story, we will take out that 1823 level. We'll probably be trading, closer to 19. What are your thoughts on the dollar MEX here?
Well, actually, do you know the interesting one? And you always have a go at me about leaving stuff off my charts. The thing that you probably should have stuck on your charts is the VIX, because if you overlap dollar MEX and the VIX index, you've got a very, very strong correlation between the two. So really the pair is trading as a risk barometer. If people are buying downside put protection, expecting higher intraday ranges on or expected movement on the S&P, then you buy dollar MEX. So it's just a risk barometer. So you tell me where the VIX is going and I'll tell you where dollar MEX is going, and I think that relationship holds up for some time. But I think it is make or break time, and I think the Mexican central bank have been unwinding some of their hedges recently, which has weakened the currency. And you've seen a little bit of unwind of carry as well, where the MEX has been a really good sort of carry currency for so long. But it could go either way now. If you take the view now that it's aggressive, but we could see some upside, a reversal back up in equity markets, oil prices go lower, bond yields may have peaked, then I think there's probably some good downside. But again, we just don't know at this stage. Buying now with this lack of clarity, I can make a really good two-way argument for risk at this stage. I know that's me sitting on the fence, and people are like, Chris, have some conviction, but it's just too hard. The move in bond yields, it could, if we were to see another leg up in bond yields on a higher CPI print, I think something could break in this market. I think something could really get taken down, because you don't have that extent of a bond move for such a period of time without shit going bad in the markets. I'm sorry. So we are at that make or break time, and I think we need new information there to get a strong picture. That's my view.
So I just want to say before we move on, Stalma approves the VIX dollar MEX correlation. There you go.
Yeah, well, as I'm talking about two men who are similar sort of age, but obviously haven't held out anywhere as near as well. So there you go. I'm talking about it. Anyway, let's go into coffee, because we got a question last week from one of the viewers. If we can bring that up. Mantaslinskas. Coffee Arabica, time to go long. Well, I think that we're actually time to go short, to be honest, Blake. I think in my opinion. Obviously, I have no idea about any positions that anyone have got, so I'm not taking that into consideration. This is my pure personal view. But we've got this series of lower highs that have been taking place, this kind of triangle pattern playing through. Technically, it's been trading pretty well. We made a re-establishment of that sort of the March lows. We rejected that one pretty much to the T. But it looks like it wants to crack. Obviously, this is one where we've got it sort of on our watch list. And if price was to sort of make a move back through those lows, I've got a weekly chart because what I wanted to bring up is there you've got an inside period. And inside bars are really good momentum tools. When you trade outside of that momentum bar, it can be a really good sort of momentum situation. So I'd be actually putting a sell stop orders through those lows and looking to ride this one. That's the way that I'm doing this. I think, just sell stop orders through those recent lows, hope to ride this one down. So I'm actually not in a position at the moment to answer the viewer question, but I think if we got a breakdown, I'll be riding that one down, and I think there's downside risks, and I'll be executing it through sell stop orders there. Blake?
Well, Mantas may have been talking about long coffee since Michael Brown was up so late, but I'm glad you brought this chart up because it is a bearish, what we like to call a bearish wedge. When you have consistent lows, lower highs, it's a bearish wedge, and you're right, the momentum point's lower. Now, I'm going to be happy because, and I'm sure you might be too. I consider myself a bit of a coffee aficionado, I can't even say it late in the day, specialist. And I love...
no American can call themselves a coffee specialist. You drink filter coffee or you drink Starbucks. It's awful. Go away.
I French press it, my friend. French press. Anyway, I've been overpaying. We all have been overpaying for coffee all of 2022 and 2023. So to see a little bit of deflation in coffee prices would be great. But it does look like bearish setup, to be frank. I have to agree with you here. It does look like a bearish setup. And let's just hope for all of us coffee quote unquote specialists around the globe that does happen, and it takes us lower.
No, I think it needs a bit of work, but I think there's if this breaks, I'm going to be short this pair. Well,
so does my French press skills, Chris. To be honest, perfectly frank. All right, let's move it over to the loonie, and I'm gonna say, put us in the loony bin. This is throw it in the loony bin. This is for a viewer question, Mike Burberry. He, I don't want to read out his whole question. You guys can, but he said, I was looking to take a long at the 200-day moving average. Mike, if you took that trade, it was the last day of the month in the quarter on Friday. We actually hit the 200-day moving average. We bolted up like a bat out of hell, and dollar buying came in, and it really hasn't stopped for days. And here's the thing. One of the things about the dollar CAD is it's right up against resistance. On my weekly video, I talked about, weakness in crude. And if that feeds through, it's going to feed into a dollar CAD buying. And unfortunately, you get, bond yields going higher, dollars rallying. So that rally just continued throughout the course of the week. We did hit channel resistance and the 127% extension. I think this is a very pivotal setup, but I think it's great because you know right where you're at, and where to be long and where to be short, and what might be the triggers, especially with all the Canadian data that's coming out on Friday with the jobs report. So, Chris, what do you think of the dollar CAD here, right at resistance?
Yeah, I think fundamentally it's a tough one. I mean, the Canadian dollar probably didn't take as much love from the crude prices as what a lot of people were hoping for. I think that's largely down to the shape of the crude curve and the influence that it has there. Getting pretty technical, but there are things to like about the Canadian. I mean, the economy is looking okay, and there's a possibility that we see a re-establishment of rate hikes from the Bank of Canada, that the market's starting to increase pricing around that. That would be, you're looking at the data flow and say that the market is opening the door to rate cuts at the next meeting, and certainly in further down the years. And that could be supportive as well if we were to see a rebound in crude. But yeah, I look at this chart right now, and it feels like the probability is looking to fade this technically in there into the top end of this range. But I just don't have the conviction either way on the Canadian dollar to say I want to be buying it against the US dollar here. But that's an interesting set. This is a setup, Blake, and the setup from a pure technical perspective suggests to me I want to be looking to fade into these levels there.
Woo-wee.
There you go.
All right.
Anyway, let's go to play of the day. Let's see what's going. Go on.
Strong Canadian data, weak US data. Let's hope.
Well, that could happen. We don't know. I mean, we're not forecasting. But that channel, we're right at the top of the channel. So I'd imagine there would be a lot of people looking to fade into that levels, regardless of their view on the dollar or the CAD. They're just saying, well, this is getting to top now. This is where we should be looking to sell into. But it depends on your strategy. If you're a momentum trader, obviously you're not going to be touching this one right now. Yeah.
Very good.
Let's go to play of the day. But pairs trade that I put out to clients yesterday and to people on the distribution is going short the US 2000 or the Russell 2000 and long NASDAQ. Now, obviously, this is a beautiful trend. And again, what we're doing is we're just looking to sell or short the US 2000, the Russell, and going long the NASDAQ as a pairs trade. Now, if both go down, we're obviously hoping, if both markets fall, we're hoping the NASDAQ falls by less. And if both markets go up, we're hoping the NASDAQ increases by more. And you're just netting off the relative performance. So it's a lower beta strategy, as we know with pairs trade. Generally speaking, if both markets go, if markets going up 2%, you might make 0.5% on a trade. So it's a low bit, but so therefore, when we do hold these positions, they become more of a position trader rather than a day trade or a swing trade. So, but what I'm saying right now is that we are going to see a slowing US economy that's going to impact mid-cap and smaller cap stocks. People want to be away from those stocks, which is what the US 2000 represents. There's a lot of mid-cap financial stocks in the US 2000, and I think we're going to see struggling times ahead. Lower credit continue to plague, and we're going to see that really impact the US 2000. At the same time, we're coming into a big earnings season. I think we're going to see good numbers coming from Apple, from Nvidia, all these companies that come into the NASDAQ 100. And I think we're going to see continued outperformance playing from there. And the performance of these big mega cap stocks in the wake of what we've been seeing in rising discount rates with bond yields has been very impressive as well. So I think this continues. I think this ratio continues to go down. I like being short the Russell over and long the NASDAQ.
All you need is just a couple of banks to go out, and then you're good to go, Chris.
Yeah, we don't want to. Obviously, yeah, that could happen. I think there's still too many banks in the US. There's still way too many banks in the US, and there has to be consolidation. But if we were to see bond yields moving up, I know they've got the bank term funding program in the US, which gives these banks liquidity, and it's saved off a systemic issue. But if we were to see bond yields continue to rip the way that they've been doing, no doubt, in my opinion, that there's going to be some casualties along the way.
Yeah, that I would agree, and that would put this pairs trade well into profitable position, in my opinion. So great choice, Chris. My play of the day is going to be the New Zealand yen. Now, I got accused this week of being biased towards how I position in the market, and the answer to that question, that's absolutely 100% correct. If I'm biased and I'm in a trade, I'm going to tell you about it. So there you go. All right. Guilty. All right. New Zealand yen, I'm actually short. I got short, into this weekly. This is a 2007 or 2009, 2007, 2015. And then recently we just hit this multi-year trend line, and we failed above it. The BOJ scare is just a scare, right? But what you'll notice is we're consolidating at lower prices, really fortifying that false breakout. Now, if we get below the 50 DMA and that 618 retracement, which basically is 87 yen, you just call it 87 yen, and around those levels, levels are not exact numbers. It's like I always joke, it's like horseshoes or hand grenades, close counts. Around 87, we start trading below that in any meaningful manner for any meaningful period of time, like a day, 10 hours. You're probably going to see a little bit of an elevator ride down from the 50 DMA to the 200 DMA. So I like the New Zealand yen on the short side. I am short, and I always like to add to my short positions. But when I add, I look at them as fresh positions. If I'm going to get in fresh below the 50 DMA and add, it's like if I hadn't known the position or hadn't been short to begin with. So that's my play of the day.
Good stuff. And I like your views. If you're in a position, let us know. It's not like, you're in a $2 million market cap stock where, you could move price effectively. I mean, you were talking about an $8 trillion a day market. And to be honest, it's your reputation that comes with you putting on the line. So that to me is more important. As long as people understand the risks on the trade, I think that's good. So I think in the FX market that you're not going to move the market on your calls at the end of the day. So no, exactly. So yeah, I think it's your reputation that you're putting on the line, and I think that's I'm kudos to you for being willing to do that. So keep it coming. Keep it coming, Blake. Thank you very much for your calls, and let us know what you're in. Anyway, thanks to everyone at home for watching the program. If you've stayed on this long, we really appreciate it. Give us a like and leave your comments. any setups that you like. Clearly, we're trying to answer those. Anything that you're seeing in the markets which we need to be aware of, and anything that you're trading that you like the look of, we want to hear about it as well. And we'll see you back next week for more of the trade-off.